Welcome back. You're watching HFO-TV, co-sponsored by AMF Capital, the Baldjanic Law Firm, the Butler Exchange Group, and the construction firm J.R. Johnson.
Welcome back to HFO-TV. I'm Greg Frick, partner at HFO Investment Real Estate. This is another COVID-19 edition of our HFO-TV. So again, we'll be doing a Zoom meeting to broadcast out. We're lucky enough today to have with us Dr. Michael Wilkerson, partner and senior economist of ECONorthwest. Mike's been with us before multiple times, so great, Mike. Thanks for coming in these crazy times. Hope you and the family are doing well and everybody's safe.
Yeah, thank you. I appreciate it.
So, we've talked before about kind of the economics. I thought we could maybe look at kind of what you see reopening the economy and the impacts on housing development that this COVID pandemic has caused from what you see. I know the data is always changing and things are kind of changing, but from what you're seeing now, let's maybe kind of jump into that and kind of get into what we think's happening and where we think it may go.
This is certainly an interesting time. When you're in school, you study what's happened previously. You learn all kinds of econometric techniques and models, and all that's out the window today. Data that's lagged by a month or more is not particularly helpful. And so thankfully we've started to see some new data. And so while we may have been reading the tea leaves a lot several weeks ago, we're now getting to the place where some data sets have evolved and we have some new sources of data that come out on a weekly and oftentimes daily basis. And that's really helpful in kind of tracking what's happening on the ground, so to speak. So I think kind of big topics, and Greg, you hit on this on the intro, what's happening today on the ground.
Right.
A lot of focus we hear about, social distancing policies and the government essentially forcing the economy into a coma. Is it that, or is it the threat of the virus? And so we have some data that's kind of going to help look at and unpack that a little bit. And that's really going to help us understand some options about what we might be looking at, say, end of year this year, early next year. And then I think specific to your audience is, what's happening on the ground today in housing, both on the kind of development side of things, but just also in general for your investors and owners.
You've been an economist for a long time, and from an academic and how do you, when it's because past kind of predicts the future, is there anything that you can kind of relate to what happened and how fast? Is it, I've heard I've told people it's kind of a combination of 9/11 and 2008, 2009. Is it like a war that started and we jumped right in? I mean, how do you guys, when you're doing your models, what's the basis, or is it totally uncharted water?
So the best case that we have is kind of applying a thinking about kind of a natural disaster, or maybe something more like 9/11, in the sense that it's an immediate shutdown.
Right.
And so I have a couple of slides here where we'll look at kind of the pace of what's been happening. For example, recently we've been doing some work with RDPO, Regional Disaster Preparedness Office at the city and metro, looking at a Cascadia event and kind of understanding, what happens if overnight you go from a fully functioning economy to one with, catastrophic damage to buildings, people, infrastructure, et cetera, and what that looks like. And so thankfully there hasn't been, catastrophic damage to infrastructure, but certainly on the loss of life side of things, and changing the new normal at the flip of a light switch is kind of what we're in. And that's much, much different than any other kind of economic related recession that we've seen before. So yeah, I think you're right that it's more like a terrorist event or a natural disaster in its magnitude and how quickly it's come upon us.
Gotcha. Okay, that's good to know. Okay.
So yeah, we can kind of look at the pace of what's been happening. And so, we hear all kinds of words. I really don't like to use unprecedented, but that's one way of looking at, what's happening. I think specifically in Oregon on the ground, we've been roughly tracking the rate of unemployment, nationally. And so we're over 400,000 people that have filed initial claims now in Oregon. And that held true through several weeks ago. And in the last several weeks, Oregon has kind of continued on at a pace that's relatively higher than the US. And so at about 16% unemployment today, and US is at about 14%. So we're by no means the worst state, but we're a little bit worse off than the average. I think we're in the high 30s and we're close to 40 maybe in terms of states with the worst levels of unemployment, say Michigan being at or near the top. And so that's kind of one way to look at it. second way to look at it is this, and that's kind of, I think, hitting at your question specifically, Greg, is here's a look at, the last 5 recessions. And if you look most recently at the Great Recession in 2007, it took 2 years to lose all the jobs. So we're now into this, roughly 2 months or so, and we're already well beyond the rate of unemployment. The actual rate in Oregon is tough because there's a lag in kind of some of the processing numbers, so it's not abundantly clear. This data came out last week from the Oregon Office of Economic Analysis. But I think the rates now, like I showed you on the previous slide, are closer to 16%. But at any rate, the rate drop is much, much faster. And so what's unknown, and as we start looking into the future, is, what does that recovery look like? And so the cycles of economic downturns have been increasingly getting longer when you look at the map, to where previous cycles might have been down and recovered all the jobs in a year or two. 2001 took 3 years to recover all the jobs. 2007 took 7 years to recover all the jobs. And that's all of the jobs. When you look at specifically sectors, and I think of interest here, it's the construction sector. The construction sector was much, much worse hit in terms of numbers of jobs that were lost. So that's, bad, but also in terms of the amount of time it took to recover, took 130 months to recover. And so I think that's helpful context and just kind of understanding if there's anything to be learned from the past, it's this recession is different. The magnitude is much worse, and what's unknown is kind of how far reaching it will be. And I think the main difference today, and this is going to last through July, is that the federal government has done unparalleled amount of stimulus and relief. And that in the form of a one-time payment of $1,200 per person has been helpful, and I have some data on that. But honestly, it's the $600 a week on the unemployment side of things, to where if you make less than $65,000 in Oregon, you actually will get your income fully replaced on unemployment, versus what traditionally is more like 50% replacement rate. So while the rate of unemployment is extraordinarily high, that's not necessarily indicative of what's going on. And so,
But now, Mike, do you think with like the PPP loans, do you think you'll see when that runs out? I mean, maybe it's not out yet, but maybe unemployment will go a little higher as you've got companies maybe saying, I've got some of the stimulus, I'm done, things haven't picked up. Do we see a new wave of people getting laid off or furloughed in July or August? Or how do you guys factor that in with, because that's unprecedented the amount of stimulus they put into the business side and that individual on the unemployment benefits?
Certainly, yeah. So, Oregon got over $3 billion worth of PPP, and nearing 50% of all small businesses that were eligible participated in the program. And so understanding how many of them are going to look to get the loans forgiven, it would be a safe assumption to assume everyone would want to, but I suspect some maybe haven't been able to take advantage of the program. For example, if your business is entirely shut down and the program gave you 8 weeks to basically keep your payroll up, and you couldn't do that, you may not look to get your loan forgiven. But I think you're right. You're likely to see kind of two opposite forces in effect. One, reopening in the hope that there's some pent-up demand, and that as businesses reopen, some of the people that have been laid off will return to work, while at the same time, as PPP starts to unwind, unless there's a subsequent program that kind of extends those benefits, you're likely to for sure see people get laid off after that PPP 8-week window ends here in a couple of weeks.
Interesting.
So, unemployment rate definitely is something that I think traditionally is what happens in a recession. Here you're seeing near 50% of households. This is a new data set that the Census Bureau came out with, and now they're doing weekly data surveys. So through the end of April, you had almost 50% of people experience a loss in income. So while the unemployment rate might be 14 or 16%, that's not necessarily measuring the extent of the impact. And so in most recessions, you don't see furloughing and other things used as extensively as we're seeing here, because I think of the nature of what happens is it takes several years. And usually what happens is it's several successive rounds of layoffs to kind of get to that peak unemployment level. Whereas here you're seeing a combination of that. And to kind of look at maybe some ideas of why you're seeing different approaches, Business Oregon put out a survey a couple of weeks ago, or released the survey a couple of weeks ago, I should say, where they're looking at the extent of their revenue losses. And so they're showing near 30% of businesses had a 90% loss in revenue. So basically complete shutdown.
Wow.
But on the other end, you have these, say 20% of companies that had less than a 10% loss. And so you're just getting completely different responses in terms of if you're able to participate in PPP, keep your people employed and have a minimum loss of income, that's one side. The other side is, these businesses that are completely shut down. So I think we're at a crucial juncture now where both the CARES $600 a week is coming up in July. The obviously the one-time payment was a one-time payment, so that's contemplated in this next package, as well as PPP. So I think the key to understanding kind of what happens next is going to be what happens federally, locally and at the state level. Their revenues have been more or less decimated. The budgets are what they are, and there's not a whole lot that they can do other than, say, the rainy day fund in Oregon, which is several $billion, but that's not enough to offset even 1 year's of projected loss. And so,
Got it.
So we start looking at kind of what's going to be happening, let's say, as we get into these subsequent phases of reopening. And so DHM has done a couple of rounds of a survey, and the most recent one, they asked people, how comfortable would you be doing these various activities? So, I think I always use the example of, what's the best business to be in right now for pent up demand? And I would say, being a hair salon, right? That's the prime example of pent up demand. That's a needed thing that you.
No, I could make a joke, but I'm not going to go there with you. So
yeah, I'm not that consumer, most definitely. But I know I can imagine what that would be like.
Right.
So, but even there, you're seeing people saying, it might take me 2 months to kind of get comfortable doing that. Going back to restaurants, 3 months. Going out shopping, 4 months. Traveling 5 months, and kind of sporting events 6 months. And so you start to look at these calendars of what the government is looking at doing in phasing, and say, for example, sporting events. I think Governor Brown has said now through at least September, but you're looking at this and people are saying, I'm not interested in doing that for at least 6 months. So there's this kind of response from the government, and then there's the response of what people are doing. And so we can look at the data and learn, I think, some interesting takeaways, specifically this kind of comparison of neighboring states. And while Minnesota and South Dakota aren't Oregon or say Washington, the advantage you have is South Dakota basically did not shut down at all, whereas Minnesota had a complete shutdown. But when you look at this chart showing kind of consumer spending, and you can't really tell the difference between the U.S. average, Minnesota, or South Dakota, and this is on a kind of weekly.
So regardless of what the state did on a governmental action in terms of shutdown, the spending and what people are doing was kind of affected, regardless if you're in South Dakota, Minnesota, national, all kind of follow the same trend.
Exactly. So I think and here's another chart you can look at this specifically where on the reopening side of things. So I think the key thing you can notice here is this is looking at Oregon, US, and Georgia. And if you look at kind of mid-March to early April as being the bottom, most government shutdowns, whether that's schools or stay-at-home orders, didn't come into effect until well after spending had dropped. So what you saw was consumers behavior had changed in response to COVID prior to any mandated shutdowns, slowdowns, etc. And then similarly, I think of interest is Georgia was essentially the first state to reopen. And you look at what happened is, at the bottom, when the stimulus payments were sent out, Oregon looked a lot like Georgia and the US. Since then, the stimulus payments, I think, had a pretty significant bump in most places. You can see that big uptick to this point here over a couple of weeks. Since then, Oregon has kind of stayed very similar. And a lot of that maybe is because one school of thought might be, well, there hasn't been reopening, and so it's kind of plateaued. But if you look at Georgia, you see Georgia mirroring almost exactly what's happening in the U.S. and certainly, large parts of the U.S. economy. Certainly, all your major metros on the West Coast are still effectively shut down entirely. You don't really see a big change in behavior. So I think this is an interesting data set. It's from Opportunity Insights, which is a research group out of Harvard. We've done some work with them specifically on housing here in Oregon. They have a memorandum of understanding with the state and are doing some interesting research. But what they're finding was essentially the decline in the activity happened prior to shutdowns. And when you start looking at the shutdowns, like we've been saying, you don't necessarily see big differences between Georgia, South Carolina, et cetera, where they've completely reopened versus places they haven't. And so essentially what they're saying is it's kind of consumer behavior, consumer fear, and reasonably until we start to see things like treatments or vaccines is what's going to determine kind of the short and medium term performance of the economy, not necessarily whether or not it's opening up or how long it continues to be shut down. So that's kind of a, what's been happening to date. And you start looking at, what might happen going into the future.
Mike, do you normally see that? I mean, I assume you do, in terms of you've got consumer behaviors going to, tap and or change or be adjusted before government agencies can make, plans. And then, like you said, on the flip side, they can make a change that we're going to kind of open or do whatever it may be. It's still going to take a while for sentiment through the public to change that behavior or go back to, not say normal, but back to a normal behavior. It's not just tied to, hey, we're open or hey, we're closed. There's this, the feeling in the public that's probably what's going to drive the economic driver, I would think.
Yeah, so that's really, I think, the key is almost everything, if not everything, that the government does from a policy standpoint, and whether that's fiscal, so cutting a stimulus check, or monetary policy, whatever it is, there's these lags, right? And some people respond quickly, some people respond more, less quickly, and some people probably don't respond at all, which is they get a stimulus check and they just put it in their bank account and save it. And so you have these various lags. What's happened here that's so different is the government basically put the entire economy into a coma. So the government took that action, and that happened immediately. And so the challenge is, on the one hand, you can immediately shut down the economy, but the flip side of that is you can't immediately reopen the economy because consumers are largely the ones who are making those decisions. And so, household by household, that varies. And I think what we're starting to see is the behavior actually varies quite a bit from state to state as well. And so the fact that Oregon, is quite a bit below the U.S. average is maybe indicative of kind of consumer sentiment here specifically, rather than, say, the policy response.
Would it be demographics, or is it consumer sentiment? Is it the type of jobs that are in place? Is there a correlation? Are you seeing the same thing? Washington, Oregon, and California more mirror each other than what you'd say, say something in the Midwest, or is it kind of state by state?
California is worse, certainly, and I think again, the outbreak in California is, so Oregon's, done a great job of getting out in front of social distancing. And as a result, I think have had far fewer cases than California. And so you can look at that as one reason. Certainly there are lots of theories out there about what's happening, whether that's related to density, et cetera. Obviously in the Portland metro, we're pretty reasonably dense, but the rest of the state is probably nowhere near as dense as the most of the states of California. And so places like New York, California are seeing much more impact from the virus. And again, I think you can use the impact from infections, and certainly death rates are an important thing and an outcome everyone's trying to avoid. But I think it's just the overall number of cases as reasonably a proxy for what's happening in the economy. And so, the government opening or not opening probably has some measure of impact on that, but largely it's going to be individuals' behavior and how safe they're being to the extent that they can in terms of limiting interactions. So I think specifically in Oregon, we have our Office of Economic Analysis is probably much better than most states in the sense that they're very transparent with their thinking and are putting good data out there to the extent that they can, and doing quarterly forecasts of what's happening. And so as of last week, this was their kind of basic thought on where the peak unemployment is gonna reach. And they're thinking it's probably in the range of 21%. And so I think, like you were saying, they're expecting continued layoffs, whether that's from PPP or otherwise, until probably midway into at least this quarter or into the next quarter. But what they're expecting is pretty quick rebound. And so what they're showing is year end something like 12% unemployment, at which point we get back on this kind of slower recovery path. And their best estimate is it could take 4 years to get back to the employment level. And so in terms of severity of the drop, this is essentially double where we are at in terms of unemployment of the last recession. But their estimates as of today are, might take half as long. And again, not trying to downplay the good work that they're doing, but nobody knows. And so this is
Right.
just a scenario, and this would be probably pretty optimistic if this were to happen. But I think what's interesting is kind of their thought that you're going to get this big, relatively big bounce in unemployment reductions through the rest of this year, at which point you'd look more like the bottom of a normal recession. And so I think that's the key of where we're at now nationally.
Are you thinking the same thing, or you think that's overly aggressive in terms of, I mean, like you said, you get this big run up in third and fourth quarter to get you at, say 14% unemployment at the end of the year, which again puts you more in kind of in line with the 07. But are you thinking, or 08 or 1980? Do you think that's kind of aggressive, or would you be surprised if we were at a higher total and maybe not back to that number by the year end?
Yeah, I mean, normally I'm not one to say that the federal government can do a lot to impact kind of the state of affairs in individual states or even metros, but I would say where we're at today is going to be entirely responsive to what happens in terms of subsequent rounds of stimulus.
Okay.
I would say this could very well happen if there's probably a subsequent round of CARES, something like was proposed and passed out of the House. But if something of that magnitude doesn't happen, I would say it's pretty unlikely that you're going to see a bounce back of this size. And
That's
so
okay.
I would, I can't imagine a scenario where no additional funding is passed, but the extent of whether that's continued unemployment payments, if that's additional one-time or multiple time or monthly payments is being discussed, if it's additional support for small business, I think ultimately it's going to be around, unemployment generally is bad because people lose at least 50% of their income. And then as a result, they spend a lot less. And so that's what kind of prolongs the recovery time. But in an instance where if we can continue to support a federal payment on top of what the state's doing, and if it's $600 a week, again, that gets you to about $65,000 or less, where you're getting all your income back. What we're seeing in Oregon is specifically and we'll get to this data in a few slides, on a rental basis, people are still paying their rents. Yeah. And kind of, able to function. I think once the shutdown is lifted, at least in Multnomah County and Washington County, versus the rest of the states already there. I think that's the scenario at which something like this could play out. Yeah.
And that bodes kind of what we've seen with various owners and management companies and operators is, the rent collections in multifamily statewide have been, better than what we thought they would be when we were talking about this, middle of March, about where we're going to be. Now the question is, are we just kind of kicking it down as some of the stimulus wears off? Where are we? April was good, May was a little bit worse, but nothing like some of the percentages people were throwing out of 20 to 30% of people not paying rent. I mean, we're still, I would say industry average probably between 8 and 15% roughly with some kind of deferral. But again, like you said, depending on what federally happens and as how much quickly we come back will be interesting.
Your 8 to 15% range. Let's keep a mental note of that, because unless you peeked ahead at my slides, you're right on the mark in terms of.
No, that's just from talking to people. Yeah.
Where we're at, and again, this data just came out last week, so we're actually able to get insights now from some federal data that we didn't have previously.
Okay.
In terms of nationally, CBO is seeing or projecting probably something similar, but maybe a little bit less of an aggressive rebound than specifically in Oregon. But they're looking at, kind of two factors here: unemployment and people kind of just exiting the labor force. And that's in numbers of people unemployed. So I think, all that to say is nobody has a great sense of what's happening in the next 2-3 months. My specific take is, without understanding what the federal response is going to be, it's really difficult to unpack what's going to continue to happen. But we can kind of look at some indicators of what's happening on the ground today. And so on the ownership side of things, you're seeing about 8% of mortgages entering in some type of forbearance plan. But you can see the peak of that was in, late March, early April.
Right.
So, if people were experiencing hardships through unemployment, et cetera, income reductions, you're seeing most of those forbearance agreements on the ownership side, happened already, and very few people entering into forbearance agreements in the last couple of weeks. On the on the rental side of things, here is where we see a pretty stark difference between what's happening in Oregon versus in nationally. And so you were, 1 percentage point off. So I'll give you credit. You're basically nailing it. But yeah, 15% of renters nationally didn't pay rent,
Yeah.
versus 9% in Oregon.
And that relates, Mike, to what we've seen, like National Association, MHA came out and gave a number, and what we've in our research found, Oregon was doing a little bit better than what they said nationally. Again, so that kind of plays exactly what we've been hearing in the last 2 months and talking to various clients, kind of what their experience is. So.
Yeah, and this is, I didn't put the source in, it's census data. It just came out yesterday. And so what they're doing now is weekly surveys of households. So this is an entirely new data set, and I think super timely in terms of being able to understand what's happening. And so I think what you might expect to see is certainly people who are unemployed versus employed are paying rent at a lesser rate. So nationally, if you're unemployed, it's a fifth of renters aren't paying. In Oregon, it's 12%. So even there, if you look at that kind of most impacted segment, in Oregon specifically, you're seeing a lot less. And so you can start looking at reasons as to, what that looks like. Is it loss of income? Also, nationally is more indicative of not paying rent than unemployment. And so maybe it's people who are losing their income, not necessarily losing their job. And when you look at it by terms of household earnings, you can really see the percentages drop off nationally, 20% for the lowest earning households. But even for households earning 75 to 100,000, you're still seeing 9% of renter households not paying rent. You look at those percentages in Oregon, and they're much lower across the board, to where your highest earning households are essentially probably no different in terms of their payment rate than it would have been prior to anything COVID related.
No, that's true. I mean, we saw some payment on some of the Class A projects, no difference than what they saw in 2019 in terms of not paying. So
NMHC puts out survey data once a week. And so I like that data. Prior to this, that was probably what we were tracking most. The challenge is they largely are looking at professionally managed institutional properties. So you're only really tracking your A and B properties. And so I think this data set is more reflective of your, the entire stock of your rental housing. But what they are essentially seeing is about 2% lower payment rate today than you saw at the same time last year. And so while the percentages are, what they are, I think most people don't understand on a monthly basis. And your owners, I'm sure, are aware of this, but you don't have 0% non-payment rate. You're nearing 9-10% on as the kind of standard rate of non-payment. And so the fact that we're at 15% nationally, at least in this data set, would be 5 percentage points different. On the NMHC, which is more Class A, Class B, it's about 2% lower.
Right. Okay. And we just posted there was a survey done by Rental Housing Association, which is more of the smaller mom and pop single family, with Multifamily Northwest within Oregon, about data collection or rent collection. So I'll make sure you get a copy of that. We have it up on our blog and our website as well, but it goes right in line with this. The one thing they didn't do and can't do, they have a hard time breaking it up by income. They tried to break it up by property class as opposed to income of the renter, but it goes right in line with what you've said in terms of where we compare nationally. So.
Yeah, no, that's great. And so I think that's the kind of story. And so, well, why is that the case? So I think largely it's the $600 a week, like I was saying, replaces essentially all of your income for people who are earning 65,000 and less. Plus you have the one-time stimulus payment. And so you look at, if are people spending it on housing? And the answer is basically no. You see, on average, 14% of the stimulus checks were spent on rent or mortgage. Another, some on food and basic household needs, paying off debt. But people were saving 35% of that on average, and certainly by race and ethnicity that changes. So that's an important consideration, certainly when you're looking at this. But on average, even if you look at your highest incidence of usage of the stimulus, you're still only spending 25% of those checks on rent and mortgage. And so I think that's indicative of the fact that this is much different than we would normally see. And when you normally see high rates of unemployment, that translates directly into challenges paying rent, and we're not seeing that, at least to date. How long that continues, I think, optimistically, if the federal response continues, hopefully we can continue to kind of manage through this worst part of the unemployment. On the starts side of things, the data is a little bit lagged, and so through March you actually saw more starts nationally in March and throughout 2020 than you did at the same period of 2019. So prior to March, we were in the longest expansion in U.S. history, and housing was down for a couple of years, but really was starting to make this late surge prior to COVID, and then you saw this 30% drop in April, and I suspect May, when that data comes out in a couple of weeks, will probably be even more than a 30%.
Mike, and this is both multifamily and single family?
Correct. Yep.
Okay.
Next slide kind of breaks out both.
Yeah,
It's
okay.
1 and 2 unit structures. You're seeing the same thing across the board.
Right.
But if you look at kind of where you're at on total units today, it's still well above where we were at the depths of the recession in 2008, 2009, 2010, 11, etc. And so I suspect you'll continue to see drops for the next couple of months, at least down to that level, at least on the starts side of things. I think starts is certainly important, and that has a lot to do with what's going to happen. But realistically, I think, as everyone and your clients are aware, apartments take 18 to 24 months to build, and so what's in the pipeline is what we're really going to see coming to market, is what's already baked. And prior to COVID, we already saw huge decreases from peak production. And so, peak production in the market, whether that's city of Portland or the entire 4-county region, was in middle of the year 2018.
Right.
Prior to anything COVID related, you have, near 50% drop in production across the board. And so there's lots of discussions as to, why is that happening? Is that inclusionary zoning? Is that rent control? Is that, what's causing that? And I think, the answer is, an easy answer is, inclusionary certainly could be calibrated better. But when you look at what's happened in the rest of the region versus the city of Portland, you don't see, a huge difference in performance. On the rent control side of things, I think too soon to see on the production side of things, because certainly, it takes a while to get that going. But when we looked at the transactions activity, and I'm sure you're keenly aware of what was happening there, we're trying to track cap rates and didn't really see additional risk getting priced in. Maybe the nature of the size of the transactions and who was buying, changing a little bit. But again, I think we were just getting to the point where we were starting to have enough data to really understand what was happening with rent control. And now with COVID, it's going to be really difficult to understand specifically what impact the grandfather period of IZ ending. So that's February of this year, right? Along with June of last year rent control, plus now COVID. You have all three of these things happening within essentially a 12-month period. Really hard to understand specifically what's happening. And I think it's going to make for a challenging policy environment. Specifically, City of Portland was supposed to look at recalibrating inclusionary zoning this year, inclusionary housing, I should say. And that budget got reallocated to emergency rental assistance. So it's unclear when specifically that process will get underway.
And probably won't be able to decipher all that through anyway. Like I said, we had the run up in 17, 18 because of inclusionary zoning. We expected we were going to see a drop down a little bit as everybody rushed to get their permits in. But like you said, with all these things happening within this time frame, it's going to be very hard to decipher, what portion of this drop or even like a change in cap rates were due to, X, Y, or Z. So it's going to be hard to kind of for a policymaker to put a plan together because we're kind of just shooting from the hip, which again, I could jokingly say they've pretty much done that anyway in the past, but now they don't even have data to kind of even back up their arguments. So, yeah,
no, absolutely, and I'm happy to talk about some kind of statewide policies that are underway that I think are going to be really impactful into this. But I think I have maybe one or two more slides, and we can kind of hop into some of those specific questions. But when you look at kind of leading indicators, you look at the architects as being those frontline indicators, and they're seeing massive drops, already worse than you saw at the depths of the recession. And so that's where I'm saying when I see this as a leading indicator, my suspicion is you're going to see similar things happening, certainly on the family side of things in the next coming months in terms of starts. How that's impacting the economy, say 6 months from now, I think is the important thing. While it certainly isn't good to shut down everything for many months, we already had a situation where we had been underproducing housing for a long period of time. And so, a 2, 3, 6 month period of underproduction is not going to drastically change that. I think it's the long run impact that we want to understand. And so I think one of the things that we've been tracking is looking at naturally occurring units or value add opportunities. And that was certainly a huge part of what was happening in the cycle at the peak of last time was, huge value add opportunities. What we're seeing today is that it doesn't really exist. And so if counter-cyclically, traditionally value add is a way that investors look to generate gains, and that's not really, at least this is national data, and obviously every market is a little bit different, but if generally speaking is not an opportunity like we saw in 2010, 11, 12, where, huge opportunities for value add, I think that's going to lead towards new development as is being more opportunistic, given that there's, not nowhere else to essentially look for returns.
And we're seeing that as well. I mean, I think we've seen, since kind of like you say, 12, 13, 14, there's been so much capital looking for that value add opportunity. They've priced out some of the return. And then the other thing is with some of the regulations in Portland specifically, it's become more expensive and more risky to go the value add proposal, to go the value add. And as well as with some of the things that have been put in place, you're seeing less opportunities of value add because owners have, you're not going to find the one that's, $500 under rented per unit where you go in and reposition the property. Those are, a lot of them have been done. And then, like I said, a lot of them have kind of got their rents up. So the kind of the delta is not as great as it used to be. So it'll be interesting, like you said, is that capital then say, do we go to new construction if whatever is available? So.
Yeah, because I think when you look at, the kind of three big factors in financial feasibility, of course, you have rent, right? It would be hard for me to think of a scenario where rents would be going up now, even though a year ago I was predicting rents would have been going up now because the lack of new deliveries,
right,
the strong performance in the economy. You could look at that and say, yeah, rents are going to go up because demand is growing faster than new supply. However, today, with what we're seeing in terms of income loss, unemployment, essentially zero migration, I don't see rents increasing really across the board. We're seeing huge concessions already happening. The second piece I think is interesting is construction costs.
Yes.
We've seen a huge slowdown in cost escalations to where we were at 15% a year, say 3 years ago. Now we were at 3% a year prior to COVID. And so the question is anyone going to get aggressive in their pricing? And so traditionally you would say absolutely not. There's no scenario in which prices are going to drop. Is that going to hold true, or is that going to be flexible? To me, I don't see either of those two things moving. Cap rate, I think, is where the opportunity lies. And so, excuse me, if cap rates have been consistently dropping for the last 15 years, that's fueled most of the expansion in the last cycle. If rents aren't going to go up and construction costs aren't going to drop, but you can squeeze some more out of cap rates, that's really the only vehicle for which you're going to see a big uptick in deliveries, especially given the fact that there aren't a lot of value add opportunities. That capital might be chasing the best opportunity. And with the, volatility in other markets, this may be an opportunity to kind of look at being opportunistic as a developer to come in similar to what you would have seen in 2011, 2012, as there's not a lot of activity going on. We might get some aggressive pricing. We might have some site control that option agreements that are, winding down, but we can take advantage of those opportunities and look to see what happens. So I'm really curious to see what happens in the next, say, couple months in terms of who's putting in permit activity, who the investors are, and specifically if we have any trades happening, what's happening on the cap rate side of things.
Well, it's been interesting talking to various developers. We've got some land sites out for sale now, and kind of what their take is. A lot of them, a couple of weeks ago, we're kind of in this whole, just kind of waiting to see what was going to happen in terms of, are they going to be able to open up sites? Can they move? But there's now more conversations and looking at that. There's that same feeling we are going to be undersupplied. So there's going to be some pent up demand, but I'm with you. The big question we've had is, if you've got this unemployment, say stimulus has, run its course and we're, 2 quarters down the road, it's going to take a while to get that job growth back, especially in the lower income strata. What does that look like in terms of rent growth? And I'm with you. I don't think you're going to see humongous amounts of rent growth. You're going to see some been up demand, but it's going to be tapered a little bit. But what you can do, we've seen interest rates have gone back down. The capital requirement's gone up, so it's going to be similar, I think, to 2011. It's going to be well-heeled, well-positioned developers that can take advantage of it, as opposed to kind of the last ones in that are more highly leveraged. They're going to have a harder time kind of moving deals forward.
Yeah, no, and I think on the regulatory or policy side of things, we have kind of 2 big statewide initiatives in HB 2001, so your missing middle housing, and HB 2003, kind of looking at your HNA, your planning process for forecasting future need. And so I think both those things are specifically, cities are going to have to look at what they're calling housing production strategies. So it's understanding how they look at their buildable lands inventory, how they look at density, how they look at delivering more units at a broader range of affordability. So you have all these various policies underway at a time when the market is, certainly volatile and not particularly easy to understand. So I think that's going to be the key, is when you get down to those local jurisdictions, understanding, what can they do to help stimulate the type of growth that they're expecting to see in their individual market.
But Mike, you've had a lot of experience in dealing with the kind of the public, policies and things like that. I mean, in a time like this, is there even the bandwidth for them to kind of get into these discussions, or is it more trying to, kind of triage what we got going on, and this is just going to get kicked down? If, like you said, so we may have 2 or 3 quarters where things are kind of just laying still until it ramps back up.
Yeah, I mean, it's both, right? So there's certainly a huge kind of triage problem, but I think what's maybe timely about both 2001 and 2003 is they laid out, a legislative timeline in terms of when those would need to be implemented from a state standpoint, and then giving local jurisdictions the opportunity to opt into state code or draft their own code.
Right.
So I think what's nice is that window for when local jurisdictions are going to start looking at their own decisions is going to be next summer. And so between now and then, I don't know what normal is going to be, but whatever normal is going to be, I think we'll have a better idea of, so that they can start to understand, is this going to look like it's going to be another 7-year recovery period? Do we see, are we seeing, more foreclosures, short sales like we saw last time? Are we seeing higher turnover in rent? Lots of these questions. I think, what you're seeing, probably justifiably so, is the highest renewal rates ever in terms of lease payments. I think a lot of that has to do with, if you can't income qualify to change rent, but you can still figure out how to pay rent through unemployment, et cetera, you're going to stay put.
Right.
And so, all these various factors of renewals versus concessions, there's a lot kind of happening very quickly on the ground. And I think in the next couple of months, we'll have a much better idea of, on the specific to housing market, what's likely to happen.
And again, this kind of change of local control, or kind of changing of zoning, this is not just an Oregon. I mean, this is going on nationally in terms of communities and states and kind of gateway type metropolitan areas looking at how are they going to handle this affordability issue if you're not stimulating development.
Yeah, and I mean, Oregon is certainly out in front in this, and so I think it's going to be an interesting opportunity to understand, how do you think about financial feasibility for a kind of new product type? If you look at missing middle, but let's just say 2 to 4 unit construction across the state, that's traditionally been 2 to 3% of your stock, and basically 0 in the metro area.
Right.
So who's going to build that? Who's going to finance it? Is that going to be ownership product? Is that going to be rental product? I think there's a lot of opportunities for local jurisdictions to kind of come in with their own code, whether that's residential infill in Portland or otherwise, and kind of be a national leader in the sense of, attracting investor dollars to build that new type of product, which is hopefully, more broadly affordable than what we're seeing today.
So then, in terms of where we are with COVID, I mean, as an economist, what are the kind of the things you're looking to see in the next 60, 90 days? Is it, how the effect if another stimulus package does or does not come through? Does that change? I mean, what are the things that are kind of the interesting components that you're kind of keeping an eye on that we could let the audience know?
Yeah, I mean, one of the things I think we're tracking is, the kind of how innovation changes the labor force. And so whether that's work from home, whether that's different delivery methods, I think what we're kind of expecting to see but unclear about is, can businesses recover in the terms of their revenue, but differently than what they're doing on the employment side of things. So that is to say, if you see like we're seeing consumer spending dropping, 16%, 20%, does that mean unemployment's going to be even more than that potentially in the long run? So if you get your spending levels back up to where they were, are you able to still, or is there the need to employ the same number of people? So that's kind of that big question about, from a policy standpoint.
Got it.
It's not just the fact that the economy recovers, it's how it recovers, because usually in these types of recessions is when you see huge periods of innovation coming in. And so on the office side of things, I think is one of the most interesting questions. Certainly in Portland, I think on the construction side of things, we built way more office than we needed.
Yeah.
And the two sides of that equation are, A, we'll need more office space to allow for social distancing, so your open plans are going to go away, or B, everyone works from home and now we need even less than we had before. And so that one I think is an interesting piece to track. But on the housing front, people need housing, so that we know is the case. And so the question I think is, Oregon traditionally in recessions has seen more people moving into the region than they have. And that trend has slowed down in the last couple of years, I think largely in part because it's not as affordable here as it used to be. And so in this next recession, if we don't see that strong in-migration pattern that we've seen, that's a good thing on the one hand, but also isn't going to help support the additional construction that we need in all areas of the state.
All right, thanks. Be safe. We'll talk to you soon, and we'll see you again next time on HFO-TV. Thanks, Mike. That was great.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.